Welcome to the JRD Solution YouTube channel, where financial education meets real transformation. Many people apply for loans, business funding, or credit approvals without fully understanding what banks actually look for behind the scenes. They wonder why applications get denied, why interest rates are high, or why lenders hesitate to approve funding. The truth is, banks follow very specific financial signals before trusting someone with money. In today's video, we're breaking down what banks really look for before funding you and how you can position yourself to increase your chances of approval and financial success. Because understanding the system gives you the power to work with it instead of against it. Number 1, your credit score. One of the first things banks look at is your credit score. Your credit score acts like a financial reputation. It helps lenders quickly evaluate how responsible you are with borrowed money and financial obligations. A strong credit score tells banks you consistently make payments, manage debt responsibly, and present lower financial risk. A lower score may signal missed payments, high debt, or unstable financial behavior. That doesn't mean approval is impossible with lower credit, but it can affect your interest rates, loan terms, and borrowing opportunities. Banks want confidence before lending money. That's why building strong credit habits is one of the most important steps toward financial growth and future funding opportunities. Number 2, income and cash flow. The second major factor banks analyze is income and cash flow. Lenders want proof that you have enough consistent income to repay borrowed money comfortably. For individuals, this may include employment income, side income, or other reliable financial sources. For businesses, banks often review monthly revenue, profit margins, expenses, and financial consistency. Strong cash flow demonstrates stability and lowers lender risk. Even if someone has good credit, unstable income may still create concerns during the approval process. That's why financial organization matters so much. Keeping accurate records, managing expenses wisely, and maintaining healthy financial habits can significantly improve how lenders view your application. Banks trust stability more than temporary success. Number 3, debt-to-income ratio. Another important factor is your debt-to-income ratio. This simply means how much debt you already have compared to how much income you earn. Banks want to know if you can realistically handle additional payments without becoming financially overwhelmed. If too much of your income is already going toward debt, lenders may see you as a higher risk. Even high earners can get denied if their debt obligations are too large. That's why managing existing debt responsibly is so important before applying for funding. Reducing unnecessary balances and improving financial discipline can strengthen your approval chances significantly. Financial freedom isn't just about earning more money. It's also about controlling debt wisely and maintaining balance in your financial life. Number 4, banking history and financial habits. Banks also pay close attention to your financial behavior and banking history. They may review overdrafts, bounced payments, account management habits, and spending patterns. Why? Because your daily financial behavior reveals how responsibly you manage money overall. Frequent overdrafts or inconsistent banking activity may create concerns for lenders. On the other hand, responsible account management, savings habits, and financial consistency build confidence and trust. Banks are not only reviewing numbers, they are evaluating behavior. Good financial habits demonstrate discipline, planning, and long-term stability. Sometimes, small financial improvements behind the scenes can make a major difference during funding decisions. Strong habits create stronger opportunities. Number 5, business structure and documentation. For business funding, structure and documentation are extremely important. Banks want to see that your business is legitimate, organized, and professionally managed. This may include business registration, tax records, financial statements, revenue history, and operational consistency. A properly structured business creates credibility. Without clear documentation, lenders may hesitate because uncertainty increases risk. That's why organization matters so much for entrepreneurs seeking growth opportunities. Professional preparation shows lenders that you take your business seriously and understand financial responsibility. Many businesses struggle to secure funding not because the idea is bad, but because the financial structure behind the business is weak or incomplete. preparation increases confidence, and confidence increases opportunity. Number 6. Relationship and trust. At the end of the day, funding is built on trust. Banks want to believe that you are responsible, prepared, and financially capable of handling borrowed money wisely. That trust is created through consistent habits over time: strong credit, stable income, healthy financial management, responsible debt usage, professional organization. All of these factors work together to build financial credibility. Funding is not only about asking for money, it's about proving readiness and reducing lender risk. That's why financial education is so powerful. The more you understand how lenders think, the better prepared you become to position yourself for financial success and long-term opportunity. Number 7. How JRD Solution helps. At JRD Solution, our mission is to help individuals and entrepreneurs build stronger financial foundations through education, empowerment, and strategy. We understand that many people are never taught how financial systems really work. That's why we focus on helping clients improve credit, strengthen financial habits, understand taxes, grow businesses, and position themselves for future opportunities. Funding becomes much easier when your financial foundation is strong, and financial growth becomes possible when education meets action. Whether you're rebuilding your finances, starting a business, or preparing for future funding opportunities, understanding what lenders look for can completely change your financial direction. Knowledge creates confidence, and confidence creates opportunity. Now that you understand what banks look for before funding you, you can begin strengthening your financial position with more clarity and confidence. Remember, funding approval starts long before the application. It starts with your financial habits, preparation, and consistency. If you're ready to improve your financial future and learn more about credit, business growth, taxes, and wealth-building strategies, visit our website today, www.jrdsolution.com. And don't forget to subscribe to the JRD Solution YouTube channel for more financial education and empowerment content. Thank you for watching. Educate, empower, execute.